Good morning, afternoon, evening, whatever time of the day you are listening to this lecture. This is Chapter 8, Reporting and Analyzing Accounts Receivable. We will be taking a very quick dive into this chapter. One, we're going to explain how companies recognize accounts receivable. Two, we're going to describe how companies value accounts receivable and record their disposition. Three, we're going to explain how companies recognize, value, and dispose of notes receivable. And four, we are going to describe the statement presentation of receivables and the principles of receivable management. So let's dive right into it. All right, we have three major types of accounts receivable. Types of receivables. We have the accounts receivables, notes receivables, and we have the other receivables. For the accounts receivable, this is due to the buying and selling of goods and services. The notes receivable is a written promise, a formal instrument for amount that is going to be received. And then the non-trade receivables are receivables such as interest receivables, loan to officers, advances to employees, and income tax refundables. Whenever we recognize accounts receivable, they are due to the buying and selling of goods and services. For merchandisers, it has to do with the selling of goods, and for service organizations, it has to do with the rendering of services. Usually, sellers will want to offer a discount in order to get their receivables back on time. We're going to discuss that as we go. They all may also want to offer an opportunity whereby the client can return goods if they are not satisfied with it. But how do we recognize accounts receivable? We have a question here. We said assume that Chapterr Company on July 1, 2022 sells merchandise on account to Polo Company for 1,000 term, 2% for 10 days, and N30 prepare the journal entry to record this transaction on the books of Chapterr Company. So we have July 1, accounts receivable 1,000, sales revenue 1,000. All right, so increase in our asset is 1,000 and increase in revenue is 1,000. On July 5, Polo returned merchandise worth 100 to Chapterr Company. So we have July 5 sales return is $100 that was returned. Again, we do not debit the sales account. We have the contra entry, which is the sales and allowance return. Also, accounts receivable is credited because the amount was returned. On July 11, Chapterr received payment for Polo Company for the date balance due. We have cash 900 minus the 18, which is the discount that was given, and that gives us 882. Accounts receivable of 900 and our sales discount of $18, which is a debit. Okay. All right, so some retailers issued their own credit cards. So like JCPenney, assume that you use your JCPenney company credit card to purchase clothing with a sales price of 300 on June 15th. So on June 15th, accounts receivable is 300, sales revenue 300. Okay, just the same way with the credit sales, the same way it goes with a credit card. If you still owe the amount from the June 15 transaction at the end of the month, JCPenney will usually charge you a 1.5%. That's per the example, per month on the balance due. So JCPenney makes an adjusted entry to record this. So we have accounts receivable for per the what do you call it? Interest. Okay, 2.25. We have interest revenue of 2.25. That's the extra that JCPenney will charge. So this is an example. This is a do it. You may want to just pause, do it yourself, and see what the answer looks like. On May 1, Wilson sold merchandise on account to Bates for 50,000. Term 3, net 15. Otherwise, you pay for it in 45 days. On May 4th, Bay returned merchandise with a sale price of 2,000. On May 16th, Wilson received payment from Bates for the balance due. Prepare the journal entries to record the May transaction in Wilson's book. So you are going to ignore the cost of goods sold. So on May 1, we have the accounts receivable to be 50,000. A debit increase in assets is debit, and a decrease in assets is always a credit. Okay, so sales revenue is an increase in sales revenue is going to be a credit, 50,000. So for May 4, or we say he returned goods, that's going to be sales and allowance revenue, that's 2,000, and accounts receivable is going to be 2,000. On May 16, he paid the amount in full, he's going to get the discount, and so we have our cash. The discount is 1,440. We deduct that from the cash to be received, which is 48,000, and that gives us 46,560. Accounts receivable 48,000, and sales discount is the 1,440. Okay. All right, learning objective 2, we're going to describe how companies value accounts receivable and record their disposition. All right, so usually accounts receivable is valued at on the balance sheet at the net realizable value. Uncollectible accounts receivable, sales on accounts raise possibility of accounts not to be collected. So each time we sell on credit, there's a possibility that we may not be paid back, and because of that, you want to be able to recognize those amounts that you think you may not be able to get back, and they're usually done on estimation basis. We have two different methods. We have the direct write-off method and we have the allowance method. For the direct method, we just no matching, so you're not matching your revenue with your expenses in the period in which it occurred. Your receivable not stated at realizable value, and it's not an acceptable principle when it comes to the gap. On the other hand, the allowance method is better in matching because you're providing allowances based on your receivables. You are able to match them within the period, and then you're able to report, right, your accounts receivable at its net realizable value, and this is also required by GAAP. Okay, so we're going to be taking a look at both, but remember that the one that GAAP authorizes or loves is the allowance method. Right, so how many accounts used in accounting for accounts presented on the balance sheet? So we have accounts receivable, we have our $500 beginning accounts receivable, we have our allowance for doubtful debt, $25 at the beginning. The allowance for doubtful debt account is a contra entry to the accounts receivable account. Okay, so this provides an allowance every single month based on our accounts receivable. Again, it's not every single thing you sell that you are trusting you're going to get back, right? You hope they pay you, but in reality, it's not always everything that you get back. All right, so when we report this on our balance sheet to get it at the net realizable value, we are deducting our accounts, the allowance for doubtful debt from the accounts receivable. Okay, and that gives us net. So we can either do it this way, right, where we have the 500 and taking it out, the 25 to give us 475, or we can just net it out and let us know that we're net of $25 to give us the same amount of 475. Okay, so this is an example of journal entry for sales, credit sales of 100. Accounts receivable is 100, and sales is also 100. Now accounts receivable has increased. We have 100, that's sales, right? And we still have our beginning 25. All right, so we have the accounts receivable because we paid collect 33 on account. Cash, this amount we collected, so cash is 33, accounts receivable is 3333. Okay, and I will put that on the credit side because it's a reduction in our accounts receivable. Our beginning for doubtful debt is still the same. Maybe they desire to have always an ending balance of 25. Adjustment for $15 for estimated bad debt. So our bad debt expenses, per the question, is 15. Allowance for doubtful debt is going to be 15. So if we're making a provision, for doubtful debt, right, it's going to be a debit to expense and a credit to the allowance for doubtful debt. Okay, so when this shows up in our balance sheet, remember we have our 40 ending, and we have an ending balance of $40. Okay. Write-off uncollectible receivable, write-off uncollectible accounts of $10, allowance for doubtful debt $10, accounts receivable $10. So we're saying this is not going to be collectible, so we're deducting the $10 from the account, and then we are writing it off on the accounts receivable. So it's going to be a credit to accounts receivable and a debit to the allowance for doubtful debt. It shows up in our balance sheet. We have $30 as our ending balance here, and 257 as our ending balance for accounts receivable. So when we deduct our 30, we're going to have $227 Now, if we're going to do the direct write-off, remember, if we're doing the direct write-off, you are looking at one period against another period. Okay, so let's assume you made sales on account, right, in 2020, and you did not get paid to 2022. You did not recognize your bad debt in the period in which it occurred. You're recognizing it when you realize that you are no longer going to collect it. And so that doesn't follow the matching concept where you match your revenue with your expenses. With that being said, we have our direct write-off method for collectibles. It just assume that Warden Company writes off ME Durance 200 balance on as uncollectible on December 12th. Warrants entry is going to be bad debt expense 200, accounts receivable 200. That's direct, although it's not acceptable. Okay, we can overemphasize that. Now, what are the features of allowance method for uncollectibles? We have estimated uncollectible accounts receivable. So that amount that we are putting aside, it's an estimate. All right, so we're going to debit the bad debt expense and credit the allowance for doubtful debt. All of that again is usually an estimate. Sometimes people use an estimate of what the total accounts receivable is, so it could be 10%. Sometimes people just want to have a total balance every single month of $10,000 in their allowance for doubtful debt account. So whatever it is, that is being used, again, is just an estimate, but you also want to expense it in the period in which it occurred. So just give an estimate, however little it may be. All right, so the credit side, which is allowance for doubtful debt, again, I said it's a contra entry. So at the time the specific amount is written off as uncollectible, now when you now decide or feel like you're not going to collect this amount anymore, say somebody one of your clients declared bankruptcy, then you debit your allowance for doubtful debt and then you credit your accounts receivable. At this point in time, you will not need to expense it in the balance in the income statement anymore, because you have done that in the period, like in period in which it occurred. Okay, so this is an example. We have Hampton Furniture has credit sales of 1.2 million in 2022, of which 200 remains uncollectible at December 31st. The credit manager estimates that 12,000 of these sales will prove to be uncollectible. Okay, so what's our entry? 12,000, right, to our bad debt expense, and allowance for doubtful debt, we have 12,000. Okay, how is it going to show on the balance sheet? We have the $200, which is the accounts receivable, and then we have our doubtful debt, which is 12,000. We deduct that, and that gives us a net realizable value of 188,000. Write off an uncollectible account on March 1, 2023. Hampton Furniture writes off 500 owed by our way. The entry on the records the write-off. Okay, so we're trying to say we're not going to collect this anymore. We are very sure that this is not going to be collectible. Okay, so what do we do? By what we've read before, we're going to debit our allowance for doubtful debt and credit our accounts receivable. This takes this person out of our books. We're saying we can't get this money anymore. Again, our bank debt expense is no longer affected because we've already made that provision in the period, at a period in time. Okay, so allowance for doubtful debt is 500, and then accounts receivable 500. All right, let's assume that this person we said was not going to pay anymore decides to pay us, right? So on July 1, RA pays the 500 amount that Hampton Furniture had written off on March 1. Hampton makes the following entries. So July 1, we have accounts receivable of 500. July 2, the credit is allowance for doubtful debt, which is also $500. And then we have cash, okay, 500, and accounts receivable 500. So what we did first is to bring back that amount because we already written it off the books. We don't have any record of it. The first thing we did was to bring it back, say he owes, accounts receivable and allowance for doubtful debt credited, and then we now receive the money, which is receive it in cash, and then accounts receivable is also $500. Again, the allowance for doubtful debt is just an account, just in case you have to write off an account. Okay. Estimating the allowance used using the percentage of receivable basis. So many times people estimate their credit or their allowance for doubtful debt using the percentage of receivable basis. Okay, so Mandy may establish a percentage relationship between the amount of receivables and expected losses from the uncollectible. So they could say 10% of our receivables is going to be, we're going to allocate that to our bad debt expense every single month. Okay, amount of bad expense is to be recorded is the difference between the required balance and the existing balance in the account. So 10% every single month, we want to have 10%, right? All of our accounts receivable in our allowance. Now we're looking at what do we have there as beginning balance and what do we want the ending balance to be. When we subtract the two, whatever it gives us becomes the bad debt expense for that particular month. So here's an example. This is what we call aging. Most companies have what they call the aging spreadsheet. This aging spreadsheet helps to give them a snapshot or a quick look into who owes them, the total amount that is being owed, and how long this amount they owe. So for example, the first one, which is TE Advert, he owes a total of $600. Between 1 to 30 days, he owes 300. The amount that he owes, which is between 61 to 60 days to 90 days, and the amount that he owes, which are over 90 days. Okay, so what they do is to allocate, spread out the money for each person that owes them, and then we look for percentage. So in the period that is not yet due, we're saying 2% may not be received. 4% between 1 to 30 days may not be received. Between 31 to 60 days, 10% may not be received. Between 61 to 90 days, 20% may not be received. And then over 90 days, this may not be received. Okay, and so once we do that, we have a total of 228, right? Thousand, which is going to be our total estimated uncollectible for this particular month. All right, so using that balance that we have, let's look at this example. The unadjusted trial balance shows allowance for doubtful debt with a credit balance of 528. Prepare the adjusted entry assuming 2,228 is the estimate of uncollectible receivables from the agent schedule. Okay, so we have a balance in our account of 528, and what we want to have as our ending estimate for the month to be 2,228. Okay, so what we do is to subtract this the 528 from the total balance, which gives us 1,700. So that will be our bad debt expense for the month, and then allowance for doubtful debt, which is going to be 1,700. Okay. All right, so we have, like we said, a debit to the bad debt expense, and then we have our adjusted balance to be 1,700. Our balance at the end of the day is 2,228. Our beginning balance was 2,528. All right, so let's assume that in the previous question we had a debit balance, and when we have a debit balance in the allowance for doubtful debt account, it tells us that we underestimated in the previous period. So what we do is having to add, that amount, the debit amount, to the total balance to give us what our expense will be for the month. All right, so we have bad debt expense. See, they added the amount, which is 2,728. Right, and allowance for doubtful debt is going to be 2,728. Again, because the debit balance, it was underestimated, we're going to be adding. If it's a credit balance, what do? We subtract, okay, the beginning balance from the total. Okay, and there we have it. All right, so we have an example here. Brule Company has been in business for 5 years. The unadjusted trial balance at the end of the current year shows they have an accounts receivable debit balance that is good, sales revenue credit balance that's good, the allowance for doubtful debt 2,000. Again, that tells us they underestimated, and what do? We add it. We're saying that our percentage for bad debt expense is 10% of our receivables, and so let's see how we calculate this. Bad debt expense is going to be 5,000. How do we get the 5,000? We are saying 10% times the 30,000 plus the debits, right? Underestimated, and that gives us the 5,000. Then allowance for doubtful debt for the month is going to be what? 5,000. All right, sales of receivable to a factor. So a factor is that person who buys accounts receivable from a company at a fee for a fee, and then he goes ahead to collect the receivables from the customers and make his own money from there. All right. So a method of disposing accounts receivable are sold to a finance company or a bank. Okay, just in order for the company to get their money back quickly. And typically, this factor will take a commission, right? And the fees ranges between 1% to 3% of the receivables. All right, look at an example. We say assume that Hendon Furniture factors 600,000 of receivables to Federal Factor. So the Federal Factor is buying $600, 600,000 of furnitures, right? Receivables. Federal Factor assess a service charge of 2% of the amount, so 2% of the 600. So this is what's going to look like. We have a credit to our accounts receivable for 600,000. We have a service charge expense of 12,000. That is the 2% times the 600, and then we have a cash they receive of 588,000. Okay. All right, national credit card sales, a method of disposing of accounts receivable. Retailer pays card issuer a fee of 2 to 4% of invoice price, recorded same as cash sales. Whenever you go to Walmart, you use your credit card. Walmart is going to record it as a cash sales to you, and then they go ahead to get the money from the credit card company. If you notice, some small businesses or even gas stations, they want you to pay the fee. They charge you 35 cents, for using your credit card, or they give you a minimum amount you need to spend in order for you to use your credit card. Okay, I know a good number of us didn't know that they always charge them for using credit card. Okay, so it's recorded as cash sales. Advantage to the retailer, they don't have to deal with you. They don't have to do a background check. They're sure they're going to get the money from the credit card company. The credit card company is the one that deals with the issue if you decide not to pay the credit card back their money, and then the retailer is able to get their money back more quickly. So Anita purchases 1,000 of sound equipment for her restaurant from Karen Musical using her Visa bank card. First Bank charges the service fee of 3%. So how do we record? It's a credit sale. That's $1,000 for the credit. That's a credit, and then we have service charge of 30, and then a cash of 970. So that's what the company is gonna get back. 970. This credit card company is gonna get $30 from them. Okay, and that's the reason why some people will charge you for the credit card sales up front. All right, so there's do it 2B. You may want to take your time to do it yourself first, see how you do, and then come back to see what the answer is. So we have Peter M. Kelly Wholesaler Company needs to raise 120,000 in cash to safely cover next Friday's employee payroll. Kelly has reached its debt ceiling, so he can't borrow debt anymore. Kelly presents balance of outstanding receivable total 750. Kelly decides to factor 125,000 of its receivables on September 7, 2022 to alleviate his cash crunch. Record the entry that Kelly will make when it raises the needed cash. So they're giving out or selling their 125,000 accounts receivable to another company. So accounts receivable, which is going to be a credit, 125. Our service charge is 1%, so that will be 1,250, and then the cash that we receive as a company is going to be 123,750. Okay. All right. Number 3, explain how companies recognize value and dispose of notes receivable. How do they dispose it of? So we have our notes receivable. A note receivable is a promissory note written by a person stating that he's going to pay a specific amount as at when it is due. Promissory notes may be used when lending or borrowing money, when amount of transaction and credit period exceeds its normal limit. So it's used in settlement of accounts receivable. Okay, and this is what it looks like. So the payee, that's the promissory note, is a note receivable, and then to the maker of the promissory note, it is an account payable. And then we have all the terms. It tells you the terms, the amount that you borrow, who is the payee, who is receiving it, and the interest that is being paid at the end of the time, and all that good stuff. All right, so we can pay our interest either on demand, on a stated date, at the end of a stated period, and many times the note terms they express either in days or in months. Okay, for the sake of the test, you want to use 360 because that's what the textbook uses and that's what it tells you to use. And so, but technically we go ahead to use the 365 days. Okay, but for your sake of test, you want to use the 360. All right, face value of notes, that's to compute our interest, is the face value. How much did you borrow times the interest rate times the time in the terms. Again, many times when we deal with the time, you have to be careful. Is it in months or is it in days? All right, so when we are counting the days, you want to omit the date it was issued and include the date that it is due. All right, so Car Company wrote a 1,002 months 12% promissory note dated May 1 to settle an open account. Prepare entry would Wilmer Company make for the receipt of the note. So notes receivable 1,000 and then accounts receivable is 1,000. So this person had an account receivable, but they don't want to, maybe they've passed the due times, they now want to have a note receivable. And then they make this note receivable. So we're clearing out our accounts receivable and then having a note receivable account. All right. Report short-term note receivable at their cash net cash realizable. So this is the same thing with the accounts receivable. They are reported because you also make estimates for allowance for bad debts. The same thing is applicable with what we discussed in the accounts receivable. Notes may be held to their maturity date. Maker may default, right? They may default in not making their payments, or holder speeds up conversion of cash. So the holder may decide to sell it off to a factor so that they can get back their money in time. Now, whenever a note receivable is honored, it means that the maker of the note receivable paid it full. If it is dishonored, that means they did not pay it in full as at the time of maturity. Once a note receivable is dishonored, there can be no longer be any negotiation for it. So Walden Company lends Hagley Inc. 10,000 on June 1, accepting a 5 months 9% interest note. If Walden presents the note to Higley Inc. on November 1, the maturity date, Wadley entry to record the collection is. So how do we record this collection? Right? Interest revenue 375. Notes receivable is going to be 10,000, right? And then we have our cash 10,375. So we debit our cash because it's an increase in cash. Notes receivable is a reduction in that, so we're gonna debit. And interest revenue is going to be a decrease in our revenue and interest account, and that's why they are being credited. Interest revenue is an increase, notes receivable is a decrease. Okay, so how did we calculate that amount? We had the 10,000 times the 9%, which is the interest, times 5 months. Okay, divided by 12. So we have, if we represent, okay, estimate 5 months. Okay, June 1. So that's why we have 5 divided by 12, and that's what they're giving us for the year. So we're assuming that this amount that they have, okay, so suppose instead that Walden Company prepares financial statement as of September 30th, the adjusted entry by Walden is for 4 months ending September 30th. Okay, 4 months ending September 30th. So because we're only dealing with 4 months, we're going to take note of only the 4 months, leaving the November one to when it becomes due. So we have interest receivable of 300 because we calculate based on 4 months, right? Interest revenue of 300. Okay, the remaining 100 is going to be acknowledged in November 1. Prepare the entry Walden will make to record the honoring of the Higley notes on November 1. So we have cash 10,375. We have notes receivable 10,000, and then we have interest receivable of 30,000, and then we have interest revenue of 75. Okay. All right. Okay. All right. So assuming that Higley Company November 1 indicates that it cannot pay, at the present time. If it does expect eventual collection, Wadler Comp will make the following entry at the time the note is dishonored, assuming no previous accrual interest. All right, so we have accounts receivable 10,375. We have notes receivable 10,000. Interest revenue 3,375. Okay, so if instead on November 1 there is no hope of collection, the note holder will write off the face value of the notes receivable. So how do we write that off? Allowance for doubtful debt, again, it's going to be a debit and then a credit to notes receivable. Okay. All right, let's do it 3. Gabit Store accepts from Leonard Company a 3,490-day 6% note dated May 10 in settlement of Leonard overdue open account. The note matures on August 8th. What entry does Gabit make at the maturity date, assuming Leonard pays the note and interest in full at that time? Okay, so what was it going to pay? So we have our principal to be 3,400. The days is 90, and then we have 6%. Again, we're going to use the 360. Okay, so we have 3,400 times 6% times 90, which gives us 51. Cash is 3,451. That's what we're going to get. Adding our $51 to the 3,400. And then notes receivable is 3,400. And then our interest revenue is what? 51. Increase in cash, reduction in notes receivable, and increase in interest revenue. All right, learning objective 4. Describe the statement presentation of receivables and the principles of receivable management. All right, so these are the kind of receivables we have for companies. You don't have to memorize this, but just know that at the end of the day, the way we represent our receivables in the balance sheet is at its net realizable value, and that's by listing all our receivables and deducting our allowance for doubtful debts from it. What are the 5 steps in managing our accounts receivable? I'll go through this real quick. Determine to whom you extend credit. You want to be careful who you're extending credit to. Do they have the ability to pay back, or don't they? That's why before you get a credit card, loan, or whatever, they want to do a background check, see how much you make, see what you spend your money on, and see if you have the ability to pay. So you want to establish a payment period. You want to give them a length of time. Is it 5 years? Is it 3 years? Is it 2 months? Right? You want to establish. You don't want to give somebody credit and not give them a time limit in which you want them to pay. Also, monitor collections. Right? Like the spreadsheet that we had for the accounts receivable, whereby you're able to monitor each of your creditors and see how they're able to pay you back and how long they have held that accounts receivable for. We also want to evaluate the liquidity of receivables. Okay, so how liquid are your receivables? How often are you able to get back your receivables from your clients? Which one of them is more liquid than the other? Then accelerate cash received from receivables when necessary. How do you do that? You want to extend cash discounts, to your customers, so that they're able to encourage them to pay back as quickly as possible. So how do we evaluate liquidity of receivables? Accounts receivable turnovers, assess liquidity of receivables, measures number of times on average a company collects receivable during a period. So how often do you collect it? The more you're able to collect during a period, the better it is. Average collection period, assess the effectiveness of the credit and collection period, and should not exceed the credit time period. So the lower it is, the lower it is, the better. Okay, for the days, number of days. All right, so this is it. So we have the net credit sales. This is the formula: accounts receivable turnover, net credit sales, average net account. Okay, divided by average net accounts receivable, and the average collection period, the 365, divided by accounts receivable turnover. Okay, so we have this amount 9.9. Here we have 9.9 times in 2016, and in 2017 we have 9.9. This is pretty good. Structures has 10.6 times. Okay, the average collection period 365 divided by 9.9 gives you 36 days, 36.9 days, and here we have 37.2 days. Okay, that's the average collection period. The lesser the better for us. Okay, 34.4 days for stretches. Okay, 3 reasons receivables are sold. 1, the size. So why do you sell your receivable because of the site. Maybe it's a lot. You've made so much sales and you don't have any cash flow. Maybe the only source of cash that you have, you sold so much, again, you don't have the cash in hand. That's why you want to sell your receivable. Billing and collection may often be time consuming, right? Taking time to call the customers, so it could take time. And so that's why you just want to, like, sell it off and not deal with all the expenses it takes to get your money back. All right, analysis of receivable in 2022. LeBron James company had net sales of 923 795,000 for the year. It had a beginning of accounts receivable net balance of 38,275 and an ending accounts receivable net balance of 35,988. Compute LeBron James company accounts receivable turnover and average collection period in days. Okay, so still the formula. Net credit sales, that's what we have. And then the average net accounts receivable, we add our beginning plus the ending, and that gives us, divided by 2, 24.9 times. And then days in years, the 365 divided by 24.9 times, and that gives us 14.7 days. Okay, that brings us to the end of this chapter. If you have any questions, again, reach out to the Learning Center. Come up, learning, during the office hours, and if that is going to be too long to wait, send me a screenshot of whatever challenges you're going through, and we could solve the problems together. All right, see you in